Okay, wage pressure, okay? So unemployment, this is actual unemployment in advanced economies. It goes from 9 down to 6. It's kind of a long-term average space it's at right now. In the US, it's down to 4.1, right? It hit 3 point something. By the end of this year, it'll probably be 3.5, which is because we're adding jobs. Okay, there's a problem here, and there's a problem with growth. The problem is, if I want to hire somebody new, I have to pay up, right? Because I've got to hire them from someone else. And if they want to keep that employee, they have to pay up because that person is looking for another job. That's where wage pressure comes from. And we haven't been there. We've just now gotten down to, the bottom of unemployment. So wages have gone up. They have gone up more than inflation. So there is real earnings increases that have existed for the 2 or 3 years. Those are going to get even tighter, bigger in the next couple of years, 3 years. And then that's going to create a problem. And the problem is wage pressures. If I have to hire, so I have a profit margin. I'm a businessman. I have a profit margin. I like my profit margin. All business people like their profit margin. That's what they like. So if I have to pay more for materials, if I have to pay more for people, build a new plant, I want my profit margin. So what am I going to do? I have to raise my prices. If the market lets me raise my prices, that's a big question. We don't know what's going to happen. If it's a better good, if I can add a value-added service on top of it, maybe I can raise my prices. So this is the beginning of inflation. And that's what we're seeing over here, core inflation. The expectation is that global core inflation is picking up. We've seen this chart before. We've seen the expectation happen before. It looks like it's real. We don't know how big it gets. We don't know how long it lasts. Yes?
What difference is there between structural and actual unemployment?
Yeah, so structural unemployment results from a change in the structure of an economy. Like we do less industrial stuff and we add services. So that might cause employment to go down structurally. Okay, so inflation happens. We're sort of expecting a pickup in inflation. So what does that do to stock prices? The average, just looking at, these are the different CPI, different inflation numbers. You look at it between 0 and 2, that's where you get the highest PE ratio. So stocks like earnings going up in a low inflation environment. That kind of makes sense, right? It should kind of make sense. As inflation gets bigger and bigger and bigger, it takes larger hurdles of earnings for that to actually go to the bottom line in a real way. Okay? So we're still here though. We're still in that 0 to 2 range. So one of the reasons you see PE ratios, valuations the way they are, is because we're in a Goldilocks inflation space.